Do you feel like you're on a never-ending mission to seek the best returns in the stock market? We all crave financial success, and investing in the stock market is certainly one way of achieving it. But where should you invest your money?
I don't know, Jim.
We're forever wondering what stock could provide us with the best returns, which we've seen made possible on the internet. Flipping £1,000 into £10,000 and £10,000 into £100,000 and beyond.
To infinity and beyond!
It can all seem so, well, unachievable at times. But if you search far and wide, you'll always find that 1 in a million chance of success. Just like predicting that Monster Energy would go on to return 215,000% to investors in the past 30 years. Or perhaps even the likes of Netflix, who had gone to return 23,000% to investors in the past 17 years. Or even AMD, who has provided 6,000% return on investment in the past 6 years. But how do we, as investors, achieve the same kind of success in the stock market? Some may say investing into those kinds of stocks when they're trading at a fraction of a few cents is simply a little bit of luck, whereas some might say it's just a calculated risk. It's not like we're going to go all Wolf of Wall Street style when we're investing into the stock market, acquiring as many different penny stocks as humanly possible, and then just hoping and praying that one of them eventually sticks.
On a mere $6,000 investment would be upwards of $60,000.
Despite how it might feel when you think about the potential upside available. If I channel my inner Leonardo DiCaprio, a mere £1,000 investment in a cutting-edge beverage company like Monster Energy, back in the 90s, a £1,000 investment would have made you £215,000. And as a result, you're likely probably sat somewhere in the Caribbean on a beach sipping on a pina colada. But despite how appealing it might feel to only look at the upside of a stock and emulate the performance of the past, what you have to always remember in the back of your mind, regardless of whether a stock is $1, $5, $10, $100 or $500, every single one of those stocks can still lose 100% of their value and absolutely go to zero.
Ow! It went to zero!
Which is why it's so important when you're investing to take calculated risk and not speculative gambles, just like we've seen on the Wolf of Wall Street. On many occasions, investors get sold on the potential upside on a stock, as opposed to actually looking at the underlying fundamentals of a business and the actual shareholder value that it generates. Which, let's be honest, is why the likes of cryptocurrency is such an appealing investment for so many of us.
Dogecoin to the moon.
We've all seen the stories on the internet whereby some individual has invested some amount of money into some small cap cryptocurrency, it's gone through the roof, and they've made millions and millions of dollars. That kind of approach can certainly be appealing to all of us. But in some ways, if you don't treat your investments right, the stock market can quickly start to work like a casino, especially if you treat it like one. Thousands of different companies to choose from with millions of different outcomes over a specified time period. A stock could go from $20 to $100 per share, giving you a 400% return on investment within a 5-year time period. But that same $20 stock could just quite as quickly go to zero. So yes, your £1,000 initial investment could be valued at $5,000 in total value, or it could be worth absolutely nothing. It's the same as putting $100 on a roulette wheel and hoping it turns into $1,000. Based on statistical probability, it's certainly achievable, but the likelihood is guessing red or black 10 times in a row consecutively is somewhat unlikely. Just like it's achievable for absolutely anybody to go into a Las Vegas casino and hit the jackpot and make hundreds of thousands of dollars, but the likelihood is 99.99% of people simply go to the casino and lose money, yet they still keep going back for more. And that can be sometimes what drives investment decisions when you're investing into the stock market. It's that ongoing pursuit, that glimmer of hope that there is a chance, despite how small it might be, that you could just be the individual to make one single great investment that allows you to achieve everything that you want financially. But where there is that glimmer of hope, wishing that you get that winning lottery ticket of a stock, that kind of mindset can inevitably result in the biggest downfall for investors. Because when that stock doesn't provide the results in which you expected it will do, you then jump onto another stock, and then another stock, and then another stock, and the snowball keeps rolling. But the truth is, the stock market will eat up your money far quicker than your ability to find that next 10,000x stock, regardless of what your favorite YouTuber promised you.
And it's gone.
The art of investing is finding a handful of stocks or perhaps even an index and investing for the long term. The likes of Warren Buffett have shown the extreme kind of success that you can have from investing into a handful of companies over the course of a long duration of time. And the reason why I emphasize that point is because, like any endeavor in life, success doesn't happen overnight. Warren Buffett, in actual fact, made his first investment when he was just 11 years old. When I was 11 years old, I was playing on Call of Duty, learning how to no-scope people online. I didn't even know what a stock was. Nonetheless, Warren Buffett's first investment in a company called City Services in 1941 at just $38 per share went on to be a profitable investment as he sold out for $40 per share just a few years later. It's almost as if Buffett was destined to be a billionaire by day one. But Buffett's success didn't come without taking a few calculated risks along the way. In 1951, Warren Buffett invested 65% of his $20,000 personal savings into an insurance company, which he would go on to own in its entirety to this very day. And that company, as of right now, generates $35 billion in revenue per year. So as you'd probably expect, with a number of successful investments like this over the course of Warren Buffett's investing lifetime, he's actually accumulated a net worth of $113 billion.
Nice.
And funnily enough, the majority of his wealth is made up of just 10 core holdings within his investment portfolio. And those 10 core holdings make up 88.37% of his total holdings. Many of Warren Buffett's investments he's not just held for years, but he's actually held for multiple decades, and simply let the power of compounding do all of the work for him. And I'm certainly not saying that all of us out there could simply go and pick up a handful of stocks within our investment portfolio, hold them for multiple decades, and by the ripe old age of 91, we'd all be multi-billionaires.
Hell yes.
But if you do go on to follow in the footsteps of the likes of Warren Buffett, investing into a handful of good quality stocks, trading at good value, whose businesses in which you understand, then you probably won't go far wrong. Because over the past 57 years, Warren Buffett has actually been able to achieve average returns of 20% per year. To put that into practical numbers, even if you'd managed to invest £1,000 per month into a low-cost index fund, which averages an 8% return on investment per year, increasing those monthly additions in line with inflation at 2.5% per year, in 57 years' time your investment portfolio would be valued at £19,426,667.
Yeah, boy.
And the reason why I share these numbers is because it's the most simplistic approach to investing, to simply invest into a low-cost index fund like the S&P 500, which, funnily enough, you've probably guessed it, gives you an average rate of return over the course of the past 100 years of about 8% per year. So instead of changing your stock portfolio as often as you change your underwear, instead pick a collection of stocks or even perhaps an index, invest a set amount of money which you feel is affordable, and let the power of compounding do the rest of the work for you.
Tell them to bring me my money.
Because historical data shows us pretty much everything we need to know about investing. But in society, our attention is pulled from pillar to post, and the chances are 50% of you guys who clicked on this video probably aren't watching it right now because something else has grabbed your attention. As a result, we live in a society where it's so easy to get that shiny ball syndrome and look for a solution elsewhere. So break out of the societal norm, stick to one investment strategy, believe in yourself and the investments which you've made that will actually pay off over the course of your investing lifetime. Because as it says on The Wolf of Wall Street,
The only problem you're gonna have is that you didn't buy more.
So with that said, guys, if you do want to learn a little bit more about how to build the perfect stock portfolio, then be sure to click on this video here. Be sure to drop a like on the video, guys, if you enjoyed it. Subscribe to the channel if you're new around here. And with that being said, I'll see you over in the next video.